Hello everyone, and a very warm welcome to our latest WOA webinar, an update on the supply chain finance markets and practices. I'm really delighted to be joined today by three people who are renowned experts in this field, great knowledge to share with you, so a real opportunity to learn from them and also to ask questions if you have any. So let me introduce our panelists today. I'm delighted to be joined by Steven van der Hooft, who's the CEO of Capital Chains, and also the lab facilitator for WOA's Supply Chain Finance Learning Lab. Welcome, Steven. We're also delighted to be joined by Eva Degenhardt, who's partner, MH Corporate Finance in Vienna. So welcome to Eva, and we'll be really pleased to hear your experiences of supply chain finance in the real world. And also Tony Brown, the CEO of the Trade Advisory, long experience of the whole world of trade finance, but particular SCF expertise and with a transatlantic perspective on the matters. So a warm welcome to all three of you, and thank you so much for joining us. As I said to the audience, do please have questions, and we'll either deal with them at the moment in time, if that makes sense, or we'll deal with them at the end if there are more than one people asking the same sort of questions. So, supply chain finance, my goodness, it's been in the news over the last few weeks, not necessarily for always the best reasons. So I think today what we'll do is we'll obviously address some of those issues, but we also want to make sure that we give adequate time to the original purpose of the webinar, which was really to talk about new products, new trends, new development, new ways of working in supply chain finance. So I think probably what I'd do is to hand over immediately to Steven, and perhaps, Steven, we can start by just reminding ourselves what actually supply chain finance actually is, and we'll take it from there. So Steven, over to you.
Thanks, John. I think it's a really good question, even to start at the outset of this webinar. What are we talking about when we speak about supply chain finance? If you read the newspaper, if you listen to what's being said on the TV or on the radio, you hear all kinds of different versions of what supply chain finance is, what it would do, and what the benefits could be. And I think we need to go back to the original definitions that were either set out by the Global Supply Chain Finance Forum, but also by the market. Originally, supply chain finance was about dealing with two parties in a supply chain, either a seller and a buyer, or a buyer and a distributor, aimed at facilitating the underlying trade flow. So something that actually took place, typically in the form of a purchase order or an actual receivable, whereby the anchor in this, let's say, product would be strong and credit worthy, and we would be able to pass some of the risk that we would have in financing, for instance, their suppliers, back onto that anchor. That was the original outset of supply chain finance. And what we see, and I think we'll be discussing that today as well, is that this definition is moving slightly from being 99% around payables finance, given the payables of that anchor, and you can then finance the suppliers, to supply chain finance meaning more things. But I think we will also discover today that there are a lot of things that are called supply chain finance that no one in the market would actually mean with supply chain finance. So core products have always been around payables, let's say moving into the pre-shipment finance part, but really matching the physical trade. I think that's key in supply chain finance.
Okay, fine, thank you.
And importantly, it's not alone, right? So Steve, it's, you know, supply chain finance is not lending. That's a key differentiator, because it's the purchase of a receivable on a non-recourse basis from a supplier, where that invoice has been approved irrevocably for payment by a anchor buyer, as you call them. And as such, it's an extension of trade credit, but funding of the invoice that's been approved.
Yeah.
So does that separate it, for example, from more traditional asset-based lending, do you think?
Oh, absolutely. asset-based lending is a loan secured by inventory, receivables, third-party guarantees or whatever. Typically, traditional reverse factoring or supply chain finance, as we're calling it, is unsecured. Mm-hmm. It's an extension of trade credit to a creditworthy buyer, or if not impeccable as a credit, then credit insured to make it so through a creditworthy credit insurer. And that extension of credit is what is enticing the buyer to use the limit to extend out his payables to a supplier. And the supplier then gets upset about having to wait for his money, but then supply chain finance comes along and says, well, actually you can have 98, 99% of it up front because we'll buy your approved invoice now for cash. And we'll take the risk of the creditworthiness of the buyer. So you've got your money up front, usually at a cost that could be very competitive to the supplier's existing cost of money, or in certain cases with developing countries and smaller exporters, the buyer's creditworthiness could unlock a cost of funding much lower than the supplier can avail himself of or herself of in his or her local country.
Right. Okay. And so, Eva, would you agree with this working definition that supply chain finance is really a subset, a family of receivables finance?
Yeah, definitely. And I think John has pointed it out quite well that usually the supply chain finance that we're talking about here is dealing with the purchase of a receivable, and it's on a non-recourse basis. And in a very traditional way, as it was set up in the beginnings, it's always well-rated buyer, and it extends to suppliers, which usually have a lower credit rating than the buyer, and you leverage that better rating for extending cheaper financing to them.
Right.
And it really distinguishes from loan-based product types. And the Global Supply Chain Finance Forum has given exactly this differentiation. They substituted it under the SCF concept that there are also loans based on receivables possible, or loans and advances against inventory or other movable assets. Yeah? But these assets then are a collateral. And this is really different thing than what we understand under a payables finance solution.
Mm-hmm. Okay, so I mean, I think that's probably a good time then, having established this kind of working definition of what we see as supply chain finance. Perhaps to raise this unfortunate elephant in the corner that's been of Greensill. Let's talk about why they're not typical and why they're not really representative of what's been going on in our industry. Tony, I think perhaps you could start on this one.
Sure. Well, it's ironical that actually Greensill, when it started 10 years ago, actually did conventional supply chain finance. Lex Greensill and his team came from Citibank, and they were funding, investment grade buyers and having them funded by the purchased receivables funded by banks on a participation or direct basis. The train appeared to derail and then crash after SoftBank injected $1.5 billion of investment into Greensill between 2019 and 20. And that put tremendous pressure on Lex Greensill to put that money out, and led to what I think is over-aggressive expansion. But at the time, Greensill actually realized that there was a perfect storm that he could seize. The new large cap regular conventional supply chain finance programs were extremely difficult and long in the making, and very finely priced. The banks had withdrawn from supply chain finance. Has my video gone off for some reason?
Yes.
Let me restart.
So we do have a lovely picture of you there. So there we are.
So the banks had withdrawn from cross-border trade. There was a $1.5 trillion gap SME financing that resulted from that. Mid-cap buyers weren't getting the credit they deserved from their suppliers. Credit insurers were accommodative and ready to take credit risk. The trade finance market was historically stable and had low write-offs. The yields were very attractive on a risk-adjusted, uncorrelated basis. And there were lots of funders, non-bank funders, ready to put their money to work for that higher yield. So that, I think, encouraged Greensill to really expand. But the problem is that they decided to democratize supply chain finance and revolutionize it. And they thought that the technique could apply equally to a 7-day receivable as to a 12-year aircraft lease. And that wasn't the case hitherto. The speed to deploy funds resulted in a 90% concentration of buyers, according to Bloomberg. Particularly a good friend of Lex Greensill's, a guy by the name of Sanjeev Gupta and his GFG Alliance SEAL Group. But the quest to differentiate and to innovate led to things that were really very, very unusual. Payday loans for the British NHS, aircraft leasing to Norwegian Air, and long-term project financing based on so-called future or prospective receivables under purchase orders that hadn't actually been issued yet from buyers that didn't even know the supplier. And those were really not part of the mainstream supply chain finance programs, and in fact are now being investigated by the German regulator for possible fraud. The assets that were the basis of Greensill's funding, whether actually payables or receivables purchased or loans extended, appear to have been commingled with common, SPV, special purpose vehicle, structured trusts. That's perfectly normal. The double trust bankruptcy remote structures were quite usual, and those were the basis on which investors in Credit Suisse were making their investments in these funds. But to make those investments attractive, they had to be credit insured or credit enhanced. And there's nothing wrong with that either, except that they had some bad debts. There was a bankruptcy or a fraud involved Agritrade in Singapore. NMC Health went bust. A retailer called Bright House got into trouble. And as a result, by July of 2020, Tokyo Marine, through their subsidiary BCC, decided to quit credit insuring Greensill's buyers. And that was unfortunate because they were the only credit insurer. So the risk of concentration in only one source of credit protection was unfortunately a disaster, and it unraveled the whole game. It really raises questions about Greensill's internal due diligence and credit underwriting criteria, as well as the controls, the mandates and the credit analysis that were in place at the fund level, so that investors knew that what they were getting into, or they didn't know perhaps. And now even credit insurance is beginning to wonder whether or not those funds in those credit insured vehicles were in fact credit insurable to the extent that there weren't any receivables. So, whereas our friend Lex Greensill wanted to disrupt the market, I think he ended up disrupting his own company. And now we'll see what the legal consequences of that will be.
Okay, well, thank you for that discursive review. I think that gives us a really clear picture of how something started out as what we describe as a traditional approach, but frankly has transformed itself in a rather Frankenstein way, if I can call that word. Stephen, any thoughts to add to that story there?
I think the bottom line is that if you look at supply chain finance, it's a very boring product. And that sounds weird for someone working with it on a daily basis, but the concept of supply chain finance is so easy that if you give me a very small piece of paper, I can draw the mechanics, which means that if it's not that difficult to understand, it's probably not a product where you can make a super high margin on. And in essence, what you see is that supply chain finance, for the most part of it, is high volume, as in throughput, low margin, but very stable returns. And if that's okay by you, if you like that kind of a return and you like the product specifically for that reason, then supply chain finance is a great product to get in. Mm-hmm. If, however, you're looking for a higher return than what the typical supply chain finance programs are providing, then you get to a situation whereby you need to find higher risk parties, where you need to create more funky solutions, as Tony just explained how that worked. And I think in essence, where I started off saying that supply chain finance is facilitating an actual underlying trade, that was no longer the case. And because you had so many intermediaries between the actual buyer and seller and the actual funder, my guess would be that, let's say, the checks and the controls and do we understand what we're financing kind of got lost in the pursuit of a higher margin, a higher yield. And I think that's the key thing, is what kind of a product is it? What kind of a return should you be expecting? And if you want something completely different, then supply chain finance is probably not the right product. And I think that's the case here.
Okay, fine. That's very clear. Again, that simple is boring, but boring is good. I mean, that's once it starts becoming complicated and difficult to understand, then it's likely to be creating opportunities for difficulties that people don't expect and don't appreciate. So, I mean, Tony, you made a quick point about that, but I'd like to pass it over to Eva now and say, well, the fact is this has happened. It's still ongoing. There's still fallout from the events. How do you see this affecting the land for the industry? How do you see it? What are the likely implications? How are the regulators and lawmakers going to react to this news? Are they going to be just soaking it up, or do you think that it's going to create an environment where there's going to have to be change?
Well, a good point. Yeah, implications. This means always learn from the case. Yeah. So I think there are three parties to look at with regards to reactions on that case. The ones are the users, the clients of supply chain finance products themselves. And when you look on their reactions in the first place, there were some surveys around when it happened that some clients of multi-funder platforms might have had some concerns on how that will impact their own programs, and it soon turned out nothing. That there's no impact on them, and even the programs that were on a multi-funder platform that used the Greensill funding, like Taulia, even there a solution was found in a quick time. So there was not a lot of hassle for those programs coming from that case. Then the providers themselves, and also supply chain finance professionals like us, everybody was in the first place just trying to find out what happened, investigating what was going on, and then communicate, and really talk about it and find out what is the difference to what we regard as a payables finance program that is traditional and really works well, and what are the differences. And maybe there are also, and I have to say that there are also learnings. There were good things, and that we can actually take for future product developments. It's just a matter of how these ideas were implemented, as Tony pointed out, and whether all the risk rules that we learned as bankers for many, many years were respected or not. And on the investor side, I like what Stephen said, that if you look for higher returns, then maybe payables finance is not the right product if you look at it as a boring, low margin opportunity. I worked in the funds industry for a long time, and I was also managing funds. And you learn very early when you deal in that business, and everybody who has a portfolio knows that. Don't forget about the principles of due diligence and what is in your funds and what you invest in, if it meets your investment criteria, yes or no. And you also do not have to forget about diversification. If a portfolio is built up with large volume deals and you can grow with that quicker, yes, but probably it is not enough diversification in your portfolio then. And the moment when a fund is actually using credit insurance to make it digestible for their clientele, there rings a little bell in my head. Okay, if it needs insurance, there must be some risk. And a very traditional, boring payables finance program doesn't work with the credit insurance in the first place. Yeah. Regarding the reactions from regulations, while usually regulators take action when they feel that there is a systemic risk. And we will see what comes out of these cases, and the courts will also play a role here. But I don't see that that is such a big thing that the regulator will actually take this case as the reason for a change in regulation. And as Tony has said, I think one of the biggest problems in the Greensill case was that there was a lack of transparency, and nobody really knew or looked behind, willingly or unwillingly, what were the investments in the background. And what was in, like, these future receivables that didn't exist in the first place. So probably there will be the look more from the auditor side, more from the accounting rules side, that they use this case to again point the finger on get more disclosure in the accounting on who is using the payables finance products and how they use it and how they treat suppliers. I don't think that the regulators themselves will do a big change in it.
I mean, guys, do you share that view?
Yeah, I think the credit rating agencies will be rather quiet for the next few months, given that it was partly their doing where they rated the funds a certain way. And I think ultimately it boils down to what are we doing, right? If you have a highway and I allow you to drive 120 kilometers per hour, the highway will allow me to drive 200 kilometers per hour, but it's still forbidden. Now, if I do that and I crash, will you then close the highway? So I think to some degree, it's a case of, okay, we went too far, we'll learn from it. Who's harmed? Is it let's say, small customers who are harmed dearly? No, it's major investors. They should have taken more care. Ultimately, now that we're a couple of months after the initial, let's say, fallout, I think it will be okay-ish for the market.
But I think there's been reporting of 50,000 suppliers affected by the Greensill implosion. That's a lot of casualties, potentially. 50,000 jobs, sorry. That causes regulators to really wonder what the hell went on and how to prevent this from happening again. And I think, you know, the old lessons of due diligence, more controls, seeing more transparency are key. But I think that the technique itself has been prone to abuse. We've seen that on a number of occasions. We saw it with Carillion, we saw it with Abengoa, I've seen it on a couple of occasions where I've been an expert witness in cases of fraud, and there is a tendency to sort of push the envelope once you get given a hand and you take an arm. I think the regulators are going to want to make sure from an accounting perspective that there's no abuse, and it's good that they should, because this technique is too valuable for small companies who are supplying mid-sized and large companies for it to be flushed out because of abuse by a player like Greensill. Which
is true, but if you look at how these products work, in essence, the suppliers here, they were all paid. So the casualties in most of these cases aren't the suppliers, because they have been paid. It's someone else. And in this case of Greensill, it's the 50,000 jobs somewhere related to the GFG Alliance and how they will be able to stand up against the withdrawal of funding. But it's not the suppliers. Typically in these products, the suppliers are actually better off because they supply it, their goods will never be used, but at least they got the money.
And until the program is dismantled and they're stuck with 90 or 120-day terms and no one to fund them.
Which is true. And we saw that in the Netherlands with a large retailer. They weren't using supply chain finance. And ultimately they went bankrupt. And we had loads of smaller suppliers who got into trouble because they had the goods delivered to this retailer and they were hoping that they would still be able to sell it. And then you get to your day-to-day operations, as in, can you withdraw selling to a certain client if that client is no good? And I mean, the moment that this program falls away and you are left with the 90 or 120 days, I would wonder, why is the funding being withdrawn? I mean, weren't they supposed to be that strong and creditworthy buyer? If that's no longer the case, then I should be able to walk away. And that's also on my, as an entrepreneur, my responsibility to do my due diligence and to do my diversification of my portfolio. Yes, it will impact me, but I shouldn't be forced to continue selling, just hoping against knowing better that they will manage, because ultimately in this case in the Netherlands, they won't. And I think that is also part of supply chain finance, and also our roles as advisors, as consultants, working with both banks and corporates and let's say development institutions. How do you use supply chain finance in a sustainable way? And sustainable can mean two things there, but how can you make sure that it works a long way, which is sustainable one way, and how can you use it to actually support the supply chains to do better in the future, which is a different kind of sustainable. And I think that's again becoming and it became clear that is needed.
Can I ask you guys what you think about credit insurance and the impact there? Because there's been a long trend of credit insurers providing credit insurance to lenders, to people whose business it is to make credit decisions and underwrite credit risk. It's always seemed to me rather bizarre that, you know, the bankers and lenders should sort of derogate their responsibility or delegate it to a credit insurer. And when I was in the credit insurance business, I started my career in it in London at Lloyd's in the late 70s. It was new, actually. Credit insurers did not actually want to have lenders as their clients, and there were all kinds of frauds in Singapore, and they just didn't want to get involved with it. Now they're in each other's pockets. And I just wonder whether this event, this Greensill event, will cause credit insurers to pull back and really think, what the hell are they doing providing credit insurance to lenders?
That's a very good observation. And I think that also goes back to what you saw and see in banks, is that back in the days, as a banker, you would know a company, right? You would visit them and you would walk through their warehouse and you would see the production facility and you would understand what an engine meant, how big it was, and you wouldn't have an LC saying it's only insured if it's in the boat, if it's a massive crane and it needs to be on top of the boat. then you saw this need to create more efficiency and more tick the boxes. I mean, with all due respect, I think there's a generation of bankers that grew up ticking boxes because that was super efficient, which meant that they have never seen, nor will they ever, the inside of a company. And with supply chain finance and let's say the opportunities at hand to provide more data, get more data on what's actually happening in that supply chain, I think we will see more bankers move back to understanding what they are doing, which industry are they in, what are the key characteristics. And if you do understand that and you have that data point and you are working together with, let's say, anchors and sellers and their distributors, then there will be either not even a need for credit insurance, or you understand it so well that you don't have to push it away to someone else and you can take that margin yourself. My thoughts.
It seems to me to go back to the point of the traditional view is that you lend against an asset that's good, and the cover that you have is in the quality of that collateral, not in the fact that you might be able to insure it, which is always a step away. But Eva, you might have some thoughts on that.
Yeah, maybe just one last thought on that point, on that green cell part, because we should also take a
yeah, we need to move on
from it. Yeah, and I think when you talk to financing providers, yeah, I mean what should not happen after that case is that we all lean back and say no, we only do what we always have done, and we focus on the traditional manner of doing it, because we should not stop innovating. And Greensill was known for being a very innovative and creative company. Yes, not everything that is innovative works in the first place. Yeah, so they tested a lot of things, and with their speed of growth, they might have made mistakes. Yeah, so the question is how much does it impact the innovation appetite of the financing providers when they look at these cases, or can they take something out of what was the creative part of a Greensill that they can actually use for future product developments? And the concept of looking at future receivables in the time of machine learning and artificial intelligence that comes on our table more and more, would be wrong to ignore this. Yeah, I mean, it's not completely wrong to think about financing a future receivables if you have enough data points that give you comfort for your risk department to finance that. Maybe not at the same rates and maybe not at the same advance rate as for a payables finance, but you can look at it, yeah, and maybe create a nice solution if you have enough historical data of a good relationship between suppliers and buyers that you can rely on and do some predictive analytics on it. So probably this is the basis for providing and extending financing to such situations.
Yes, I agree. But you know, a future receivable where there's already been a purchase order issued and we're now in production and eventually will supply goods and they will be invoiced is one thing. Yeah. But to do future receivables financing against the buyer's order where the buyer doesn't even know you and the order hasn't been issued, yeah. I mean, that is farcical.
The key is, do you have enough evidence for future receivable to materialize? Yeah. So as you say, if I have a framework contract between a buyer and a supplier where there is frequent trade under this framework contract, and I see the purchase order and I see that the goods are moving and that there is data points that I can track that, then I know that very soon I will see that receivable that is then in the end also my collateral. Yeah.
Actually, I think it's an interesting point because I believe the trend is going to be more and more to take the purchase order as the trigger of what happens in these financings, because that's the origin of a lot of things, not just the invoice or the payable, but starts with a purchase order.
And that's an interesting thing, because that's always been the sort of the nirvana of trade finance, hasn't it? Sort of birth through death, sort of right from the very start of the purchase order right through to the final delivery to the ultimate customer, and everybody's step in between the two. So that's always been the challenge. I think, you know, asset-based lending, in a sense, you know, is what I would have called a cash flow loan. I look at the various classes of assets, and you know, this class of asset I'll advance so much, this class of asset I'll advance so much, and that'll give me a pool that I'm prepared to advance against. But I also might look at sort of what do I expect the cash stream to be, and if my readings of the profitability of that company are such, then I might be prepared to pay a little bit more in anticipation of that cash flowing in. But I'm always recognizing that only works whilst the roundabout keeps turning, and you always have to say to me, if it stops, will I be able to recover that extra advance, and where will I recover it from? So in a sense, artificial intelligence and predictive tools about what business might be being done in the future actually might help you make those decisions more effectively, but ultimately you're always going to be on taking a bit of a bet, I suspect.
Exactly.
Mm-hmm. So we talked about innovation, the importance of innovation, and you know, sometimes it has to go wrong. But have you got between you any recent examples of product innovations that you'd like to share that you know actually think have value and are going to contribute to the industry?
Well, I'm not sure if it's so new for the audience, because there is all these companies who are doing it, are publishing about it. But a lot of talks was about how can we extend financing actually to the very small suppliers, and especially the ones where the corporate doesn't have a direct link. So talking about deep tier financing. And there is actually, especially when you look on the situation with COVID last year, everybody was thinking of how can we make our whole supply chain and our whole operations more resilient. And here, especially in supply chains where you have multiple tiers, this is extremely important to get more visibility on what happens actually in a second tier, third tier, fourth tier. So for those cases, a couple of banks, mainly in Asia, have developed new platforms, mainly blockchain oriented, that go for this deep tier supply chain finance. We will see how that turns out. It's all very fresh. Examples for that are SBI Banco or Link Logis in China, or DBS Singapore is also making its experiences with multi-tier facilities in supply chain finance. Yeah.
Mm-hmm. That fits in with a question coming from Louis Hoffmeyer, who's asking what the role of the platforms will be. So is this something that, you know, is going to be going to become more in-house, or are people going to divert this type of business to third-party operators and buy it in as a service? How do we see the structure of the industry developing?
Well, it's interesting. The platforms are a great source of innovation. And whereas reverse factoring or supply chain finance typically was done on bank platforms, the banks originally created their own technology, then they realized that, you know, it was too bespoke and suppliers needed to have an IT department just to handle all the different IT programs that each bank had for supply chain finance. There's now more of an agnostic platform. There are platforms like Prime Revenue, there are Talia and Orbion. But what's interesting is that the whole platform activity of purchase to pay is building off of the digitization of the processing of orders, issuing of orders, receiving of invoices, and all of the paraphernalia of checking the attendant services to execute an order. A lot of those are being done now through TradeStream. Coupa is another company where the process of vendor analysis, vendor search, vendor procurement is now the basis on which they're adding vendor payment, vendor early payment. Even the payment companies like Payoneer and TransferWise, whose business was to arrange the facilitation of payments for services and goods, they're now getting into early funding of a customer's eventual payment. So there's a lot of innovation in the platforms.
Mm-hmm.
I think what's also interesting here, right, is if you speak about the, let's call it developed world, we speak about Europe, we speak about the States, we're all looking at the supplier side of the equation, because let's say the downstream part is quite well organized. If you look at the developing regions, if you look at emerging markets, they care about their suppliers and they care about the upstream part, but they're mostly interested in how can we move it in our downstream supply chain? How can we get it from a large FMCG through their distributors, wholesalers, sub-wholesalers, retailers, sub-retailers, all the way to the last mile sellers, the sellers on the street. And what you see there as well is that everyone is trying to digitize that journey. And whether that is the ordering, whether that is the logistics, whether that is just pick any part of a physical supply chain, they'll digitize it with the thought that ultimately they'll be able to use that data to finance. And while that's a good thing, I mean, bottom line, any data point that has been generated in a supply chain which is not transparent or which is lacking, let's say, clear visibility for the main users in that supply chain is good. You also see a massive, let's say, build up of small initiatives, which means that I'll be able to work on this element with this provider and on that element with that provider. And what I was hoping 5 years ago to see by now, which I haven't seen yet, is almost like a platform of platforms. So the combination of what I can do as a supplier on the Prime Revenue portal, as Tony was mentioning, or the Tolia or the Orbian, or just pick anyone's platform, is I still have to go to all of these separate platforms with a separate login. And what I'm hoping that we will see is more of the ability to plug and play even these platform offerings, because that will make the uptake so much easier for, well, especially the smaller nodes in these supply chains.
That's an interesting point again. The diversity of providers here and the competition that goes with that. You know, do we envisage, you know, the market actually polarizing, thinning out as, you know, particular suppliers become more successful? I mean, that would be the normal way one would expect a market to develop. But there's a question here from Tim Davis, who makes the point that until now, these programs, payment programs, have generally been the preserve of large-scale organizations. Is there an opportunity for fintechs to, if we can call it, democratize that, to bring that down to the smaller scale companies? Do we actually see that as an ideal, or B, is it actually happening? You know, are the fintech platforms making SCF more accessible to a broader range of businesses?
Yes, and the interesting thing there is that while the mainstream platform providers and fintech providers have the capability of going into these smaller supply chains, I think there is always the debate of where can I spend my resources. So if I've got the choice between doing the smaller suppliers, which technically I can, but it's going to yield me X, or I've got another client lined up to do the largest suppliers, which will cost me the same amount of effort, but will yield me Y, which is 2 times X, you know where they're going. So especially working in the emerging markets, you see that there's a lot of smaller fintechs who are effectively leapfrogging from what some of the established players have created. It sometimes even looks the same way. I would almost say that it operates the same way. The only thing is, once you dive into some of these platforms, you'll find that, well, the look and feel resembles the original platform, but some of the functionality that you can't see unless you use it is different. But they want to go to these markets. the technology is not the issue typically. I mean, it's quite scalable. It's more a question of how efficient can you bring it to those smaller nodes. And for a bank provider, that will still entail doing KYC. And if you have a funkier structure where you can outsource the KYC, at least partially, it will become easier. So it's also a matter of, are we in a level playing field? And I think we're not always in a level playing field. But fintechs themselves, they can go there, they want to go there, but not always the mainstream players. You will see the smaller players picking up those fragments that are still interesting to them.
Yeah, I agree. I think innovation always tends to start with smaller companies, and then once proven, the bigger companies come in and commercialize it or expand it because they have the capital to be able to do so. But you know, you look at little companies like, and not so little anymore, like Drip Capital. You know, they started small, but now they're doing $1 billion plus in volume. They originated out of India. Lots of innovation going on in supply chain finance out of India, and they understand the imperative of dealing with small companies. I think there's a lot more innovation to come, and I think the convergence. I'm a strong believer in the convergence of trade, finance, logistics, and data. We haven't even scraped the surface of that opportunity yet. Yes, there've been some examples which didn't work out with logistics alliances, but I see more and more. Last week, another one came out in the US. King Trade Capital tied up with a little logistics company to provide PO finance and trade finance. Lots of these will happen. Not all of them fintech. A lot of fin, not so much tech, but eventually people will harness tech because it'll just be that much more efficient and more transparent, and you'll be able to risk manage a lot better.
Yeah.
Just always smiling a little bit when we all know that there's a lot going on in technology. And technology can enable a massive move into financing also the small tickets. It doesn't matter for that machine whether it's a small or a big ticket. There is just a functional algorithm behind. Yeah? So that is possible. The real problems when developing products in emerging markets and developing markets, they are totally different. They are in the foundations. The enabling framework of doing this type of products sometimes doesn't exist. So it's about regulation, it's about laws, it's about enforcement system, it's about, yeah, I mean, even if the technology is there and even if there is fintech and newcomers also in that countries developing fancy technologies, you cannot really use it at scale as long as the providers don't dare or cannot dare because of other risks that are still in the enabling framework. So that's the problems that we face when working in emerging markets at the moment.
Yeah, I think it's a very challenging area. If you want to get beyond payables and receivables, which I think eventually we need to find a way to finance production. That's where the real pain point is. I've got a purchase order. I'm a small company. My bank isn't providing the finance that I need to grow, but I need money to buy the raw materials and to make the goods for which I have an order. That production finance is the really tricky challenge in trade finance. And technology, digitization, track record analysis, history that's available on a digital basis can provide a tremendous amount of support in that area. But I also see more and more companies looking to finance the payable, if you will, by stepping in to buy the goods from a seller and hold those goods and then deliver title wherever the buyer wants those goods whenever they do. And the idea of inventory as a service. And it's a very current thought because as we move away from bricks and mortar in retail to e-commerce structures, inventory is the asset that continues from production through shipping, and only at the last minute does it change and is sold for cash. There's not much of a receivable when there's a credit card paying for the goods, but there's a hell of a lot of inventory that's in the supply chain, and how we handle that inventory is going to be very interesting. There are a couple of companies that I'm working with, one in Switzerland called Arviem, another one in the UK and Italy called Supply Me Capital, who are actually focusing on financing inventory by taking ownership of it and delivering it to the buyers where they need it, when they need it. The challenge is, coming back to fintech and finance, is how do you get the investment community comfortable with funding inventory that might have been sold but is in transit and hasn't been delivered? And that's a huge educational challenge because people don't quite yet understand trade finance, sadly.
And I think it's also coming back to that point of data and the analytics part. I can hold your inventory, but how do I know that it remains current? Right? Yeah. So I need to understand that the inventory that I'm holding for you will not be obsolete by the time that I'd like to sell it to you. And again, you get to understanding, what am I dealing with? Who am I dealing with? And what is it that I'm ultimately financing? If it makes sense, I'll be able to find an investor. I'll be able to finance it. If it doesn't make sense, or I just don't know, then it will be a hard sell. And I think that's part of the, well, you're saying that the clients that you're working with, I would say almost the mission that we're on is educate the market, know what you're doing. And I think that's almost like a day job in itself. It's just providing that education on what is supply chain finance, what is it not, where can you use it, where can you not use it, who's a solid player in the market, who's not. And if you do that on a consequent basis, what you effectively get is that vibe in the market of, hey, actually, I get it now. This is cool. And I think we've got that vibe. I mean, someone gave it to us, we understand it. And it's almost like our job to pass it on to others and say, hey guys, this is a very cool and neat piece of boring is simple and simple is good, or simple is boring and boring is good business. And I think that's ultimately where we're at. We need to make sure that people get it.
And particularly young people who are coming into our industry.
Yes.
So trade finance was regarded as being a boring, sleepy old vestige of old people like us. But actually, it's a really, I exclude you there, but I definitely qualified for my jab early by virtue of my age. It wasn't my sagacity, I can assure you. But anyway, the point is that young people need to be brought into this very, very innovative, exciting area.
Yeah. And as you mentioned that point, young people. I mean, what are young people interested in at the moment? What's top at the agenda of many governments at the moment? It's about sustainability. And the EU has just signed last week the deal reducing the carbon emissions by 55% by the end of this decade. So this is a massive thing to support to be supported by the financing industry. So the train is going and the trend is going also in the direction of providing sustainable supply chain finance, which could be a very nice add-on to the boring existing supply chain finance products that they already have. Of course, it's not something that you can set up just like that by tomorrow. There's a lot of thought and effort to be done. But if you subsumize it under two terms, it means a lot of change and in the mindset, first of all, but also in work. And it means a big opportunity for the clients as well as for the financing providers to leverage on that trend. And I think the corporate procurement departments have the biggest part to do to establish this. There's a lot of work to do it, but a lot of corporates have already some form of ESG supplier assessments in place. it has to be enhanced by further criteria that can be tracked and used also for a sustainable supply chain finance program. And banks already started to integrate ESG criteria into their risk assessments, and it has an effect on cost of funding, even for the financing providers themselves. I mean, they are looked at by their investors, and all the new regulations that come, and there will be no additional ones, I guess, that will support that corporate environment as well as the financing provider environment goes that path. And we should jump on that train and develop the right products.
Yeah, and I think it's even more important that everyone who's in this call jumps on that train with us.
Yeah.
We don't want to jump alone. So I think that's an open invitation for everyone to join us on that ride, because I think that's the exciting bit, which is new and current and very topical as well.
Excellent. Well, thank you for that. Yeah, I think just one of the things that occurs to me is in terms of the increasing role of data and technology and intelligence in the supply chains, as well as the finance side of it, is the actual logistics side of it. I think one of the things that we've seen over the last year is the way that over-rationalized supply chains have been failing, because they work on just in time, they work in assuming that things will get through, and we've seen difficulties with that in the chip industry, in the components for vaccines, in terms of large boats blocking up canals. It's one of the things is that, have we got to a stage where things have become over-optimized? And I think that, again, in terms of sustainability, one of the things that technology is going to be able to do is to say, are there better ways of moving resources around the planet so that we're not moving so many, so far, so often, and in a way that is more amenable to doing it in a low carbon way. So I think there's the sustainability side of it fits in from the sort of physical movement of goods, as well as the actual funding of it and the intelligence that goes behind making those systems work. So I think there's a huge amount of opportunity and development for the future of this industry, and actually the smart kids coming in and making that work better than it does now. So I think there could be a real chance for that. Anyway, I think it's probably for a time for us to start thinking about wrapping up, because we're coming up to our hour. So maybe just some last quick thoughts from each of you about where we are today and the next steps.
We should start.
Mm-hmm.
Well, if I may, I think the supply chain finance industry is quite mature already. We have seen a lot of growth rates in the last couple of years in that particular space of payables finance and supply chain finance, and it is not the time to stop innovating. We should keep on going, looking for additional solutions, new space, and I think especially the last one that I mentioned, the sustainable supply chain finance, is a big opportunity to dig into and to be onto.
Excellent, thank you. Tony, any last thoughts?
I think there's not a lot wrong with supply chain finance as it currently is. There's a lot of criticism coming to it by virtue of recent history and events that have happened with Greensville, etc. But it works. The funding is there. The funding is very interesting and very interested, because there is a higher risk-adjusted return that's not correlated to the stock market. I think global trade is going to increase. We've heard rumors about trade dropping off. I think it's coming back and roaring back. Sustainability will be critical. Digitization is a huge catalyst, which will spawn a lot of innovation. And I really hope that that's going to happen in the area of inventory, production financing, and helping companies provide for just in case inventory levels rather than just in time.
Okay, thank you. And Stephen, last words for you as lab facilitator of supply chain finance, Learning Lab.
Yeah, I think I just want to thank everyone for joining this session, and thank my co-panelists and yourself, John, for their insights. I'm expecting supply chain finance to go way further than where we are today. I think there will be many more developments coming from the digitization of the actual trade, the insights being generated. We didn't speak about all those nice technologies around blockchain, etc., but I think all of these will see more materialization in the coming years. It's not going to be an overnight story. I'm happy to be part of it, and I hope that everyone on this call will join us for that ride. And I think that's my hope also from a WOA perspective.
All aboard.
That's it.
Excellent. Well, I think that also you're right, Stephen. We talked about a lot of things, but there's a lot of things that we haven't talked about. So I can feel the content of another webinar about the technology, the futurology of it coming on, and look forward to that. So I'll bring it to an end now and say thank you all very much for joining in. It's been a great discussion. I've really enjoyed it. So thank you all very much indeed. And goodbye to all our audience. Thank you.
Bye.
Bye.
Bye-bye.
Thank you. Bye-bye.